Konnichiwa, ni hao, guten Morgen, good morning. All right, currency traders, let's get this party started. Thank you for being here today. I love doing these sessions with you. You keep me focused and sharp. If you're watching a recording of this, please leave a like or a comment, depending on if you're watching it on YouTube or on forex.today. But participate and share, if you will. Pay it back. So, yeah, welcome, currency traders. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. It's an ECN that allows you to trade not just Forex, but energies, metals, indices, and binary options. We do these sessions every single day. They're absolutely free every single day. You attend at forex.today. 7:30 in the morning is when we start. I usually go somewhere between an hour and a half. And on Fridays, we do these sessions at fxstreet.com. So please join, please attend, and then please ask questions and interact. We've got a lot going on today. And in fact, I was thinking again how blessed we've been recently with the price action that we've been given by the Forex gods. I've traded for many years, many years, and I've traded through the summer of each of them. And this might be one of the best summers ever. I mean, there's been some good trading in here. So I'm thankful for that. And again, like I said, I'm thankful for you being on my team. So let's get going. Trading's risky, not appropriate for everyone. Your past performance, good or bad, is never indicative of future results. So stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. And hopefully these these daily educational webinars are helpful and you're learning things when you feel comfortable to trade real money because of the success of you and I working together. Maybe, just maybe, you'll choose TradersWay as your broker and your trading partner for many years to come. No, there isn't a specific trade, Sean. It's just put everything into context, Sean. Sean says, can you go through some of your good trades? There isn't like good trades. There's just been good trading for the summer. So last summer, for example, we had the least amount of volatility in the history of Forex. So we would sit for hours, and nothing would happen. And then when it did happen, it wasn't that big of a deal. Like literally, the USD yen could move 30 pip over the course of 5 or 6 hours. Okay? So I'm just saying, always look for the good. We're always trying to build confidence as traders, and we should be thankful for what we've been given. And we've been given pretty good trading conditions for the time of year. And I'm thankful for that. There are opportunities to do well. Now, is there one particular trade that's so ripper awesome? No, that's not what I'm talking about. But you can make money and you can be surviving. Okay, this is way better than last year. Okay, cool. So, oh, didn't fire up my drawing tool. Let me do that, and we'll go through the charts. Come on, drawing tool. All right, so here's USD yen. And yesterday, on the back of Bank of Canada's interest rate cut, we got a breakout. You tell me, what have I taught you to do when you get a breakout? Igor should have this one down since I drilled it into him yesterday. Okay. Yeah, you wait for a retracement and a retest, right? Now you draw a fib study, and ideally somewhere between the 382 and 618 Fibonacci retracements, you will go long, right? Well, in fact, I just noticed I didn't draw it quite right. Let me do it this way. Let me draw this again. Okay, you need to eyeball the role reversal. Okay, it's not always the role reversal, but almost always very close to the role reversal in which the continuation pattern happens. Okay, yeah, that's what you eyeball. The second thing that you do is the fib study. Okay, this is the 382. This is the 50%. All right, and this is the 618 of yesterday's trading range. But you could also fib this area, okay? And that's about a 50% of that, okay? You'll notice that it's today's central pivot point. All right, so you fib the recent move, which is fine, because remember, this is all subjective. So you can measure the high to the low, like this range, and fib that. That would have been acceptable. Or you could fib the whole daily range, which is this range, the low to the high. And general plan that, and I've taught you this dozens and dozens and dozens of times, right? It's not like I'm making it up after the fact. I mean, dozens and dozens and dozens of times in all time frames and all scenarios. But it retraced to the daily central, which you could identify as support, to the 382, tickled the 50%, which you could consider support, right? So on and so forth. And what did it do? Continued up. But isn't that what it was supposed to do based on technical analysis? Okay. So like I said, we should be thankful for that. What would happen last year was this USD yen would go up 200 pips and then it would come down 175 pips. All right, you get a move like this and you'd be down here 2 days later and you're like, well, what the heck was all that about? And then it would do it again, but not quite as high, and then it would come all the way back down. And then the next one would come up not even as high as that, and it just wedged for like 3 months. Maybe more, if I remember correctly. Okay? So just basic fact that it's, and going in the direction I want, of course, that it's behaving nicely. It's tradable if you have plans in place. And that's what I'm thankful for. Okay? I don't want to fight you anymore. It's you I'm fighting for. All right, come on, charts. All right. Yeah. Well, let's put it in context. This is the dailies. Okay. What did we cover in the past? Okay. Remember, always put the. Notice that we do things like this. I don't know if you think I'm doing these things randomly, but you should pay attention. Like that, we go over the daily charts on some of these setups over and over and over again, and I keep realigning the satellites. Right now, this is oil. We'll move out of the way, but I just want to bring up, the fact that we'll look at these things. All right. And we'll pay attention to role reversal areas, and it's the same even with commodities as it is with currencies, right? Now, do you remember the plan with oil? Down to 50? $50 a barrel is right here, right? That was supposed to be an arrow. Okay. And all it's doing is if you were a bull, you would probably look to buy, but I'm suggesting that it's just not less than 50. People get pretty squirrely, so they're going to probably want to support it, but there's no reason for this to go to 70 or beyond 70, let's say, right? Well, Marcia asks about USD CAD. Well, I am talking about USD CAD. Yeah, okay, this is crude oil, but what do you think is generating the weakness in the Canadian dollar? Right. So, anyways, I said this a couple of days ago. I kind of expect us to be in a maximum range like this for a while. Okay. Right. And Ron says, especially when you bring in the Iranian oil, which we did talk about yesterday and maybe the day before, right? Do you guys remember the speech that if you can just achieve a basic level of consistent profits, like 2% a month, that if you can do it over the course of time, let's say for 2 or 3 years, you can show a track record, ideally trading other people's money to show that you have experience as a pro, and you could produce 2% a month, month after month after month, sometimes a little more, sometimes a little less, but generally speaking, no one can count on that. They can count on it. If they gave you the money, it's almost guaranteed to be in the bank because you're consistent through all different market conditions. Then there's all the money in the world. Because you say, well, Wayne, I want to be a currency trader and I want to be filthy, stinking rich. And I'm like, good, how much money do you have in your trading account? Oh, I got like $4,000. Well, all right, so why don't you grow that into 2 million and then start trading? Right. And you're like, well, that'll take 1,000 years. Right? Well, that's why there's money available around the world, right? Right? There is a lot of money. So if you can just focus, don't focus on the big money, let's become a millionaire as soon as possible, right? If you can just focus on the next 3 years, just generating very consistent through all market conditions, a small but steady income trading, something that you can prove to somebody else, then there's millions and millions and millions and tens of millions, hundreds of millions. There's billions of dollars out there for Forex traders that can produce consistent results in all market conditions. Slow growth, low volatility. And so that's one of the things we talked about is, this this Iranian deal, if this gets done and they remove all the sanctions, there's billions of dollars locked up in Iran right now of very wealthy people that can't get their money out of Iran, and it's been locked in Iran for a generation. And soon as that those restrictions are removed and they're allowed to trade their money or move their money around the world legally, then that money is going to be available. There's going to be so many forex traders out in Dubai or even out in Tehran, but most of that big money is going to move to Dubai. But anyways, there's going to be lots of money available for investors, professional forex funds, and everything. It's just going to open the floodgates. Suddenly, there's going to be a lot of people searching for that money, and that money is going to search for people. So, like I said, that's just today. That's just what's happening right now. What the world lacks is someone that can consistently produce, small returns. Remember Bernie Madoff, the scumbag liar that ruined people's lives. How did he attract all those billions of dollars? What did he promise them? What did he promise these guys that attracted billions of dollars from very sophisticated people? 1% a month. That's enough, guys. See, the thing is, if you made 1% a month but never lost, then people can count on that return. That's all the big money wants, guys. Yes, compounding kicks. But the issue is that in long-term, big investors don't want volatility. They don't want you to make 20% one month and then lose 9 the next month. You'll never attract more than $10,000 from some amateur investor that isn't smart enough to realize that that's bad trading. They want to be able to account for risk. People don't want risk. Volatility is risk. But if you can produce steady returns of any sort, then they can say, I can count on this. It's like a unit of accounting. All right, I'll put this in, I'll get that back, and it'll grow, and I'll balance this as part of my portfolio, because a sophisticated investor will have like 27 different things in his portfolio of various types of risks, and they know where to put you. So anyways, I'm just saying, focus on the right things, guys. And if you can just do that, and you want to be a professional Forex trader, there's more money than you can possibly deal with. Okay? And if you're doing that already, you need some money, just contact me. See? How easy is that? All right. So, here we go. What are we looking at here? USD kitty cat. Okay. There's the initial move. There's the plausible entry. Okay. Is that catchable? Just trying to get this in there so you can see it. Wasn't a 382. Let me adjust this. Do 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 do. Boom. That's catchable. Yeah, Igor says the market's moved a lot, like I said. Yeah. Well, the good news of that is that you'll understand next time, right? When you get a fundamental move, guys, you can't trade it technically. It's just that simple. So the idea here is some situations you have traders just buying little Fibonacci retracements and they're buying bounces at support and resistance. And then there's other situations where institutional investors are rebalancing their portfolios. They're going to behave differently, these two conditions, right? Yeah, well, if you were there, I told you it wasn't going to behave like that. So in that case, and pay attention, write this down. Most of the time, the markets will trade based on the rules of technical analysis. Because most market participants now use technical analysis becomes a self-fulfilling prophecy. However, there are times when it's not a technical move, like a central banking change in policy. If Yellen says, we will raise interest rates in December, what, you think that's like a little scalp? Someone's trading a 5-8 cross on a 15-minute chart? Oh, it's the 4-hour stochastics. No, and I was clear at the time. It's not going to do what it would do in a normal market condition of just little technical analysis. It's probably not going to pull back because you're now fighting. If you're waiting for a retracement, why would it retrace? $100 billion is moving right now. Now, maybe not 5 minutes ago, but for the next amount of time, whatever that is, for the next few hours, hundreds of billions of dollars needs to change hands. It's not even a want. It's the central banker, the chairperson of the central bank that manages the value and the yield of the reserve currency for the entire planet just changed a policy. Yeah, guess what? You might not get a 5-minute pullback. So you have to understand that and trade it differently. How often does this occur? Not that often. But you have to discern the difference of, is this, an everyday kind of trade? Is this, is this just a basic, boring kind of day? It goes up, it comes down, it goes up. Or is this a really big deal? And if it's a fundamental change, then it will behave differently. And it's going to be like a tsunami. If you've ever seen those horrible tsunamis in Japan, right? Just imagine that being money. It's going to go one way. It's going to go wherever it wants to go. And that's that. There's nothing that you can do about it. Except, I don't know. I can't think now that I've said it's a tsunami. There's nothing positive I can say about it. But you're certainly not going to be able to fight it. And it's going to go where it wants to go, and it's going to go there quickly. So write that down, understand it, so on and so forth. No, and that's why I didn't want to say it that way, Lawrence, right? Like, I didn't want to go there. But just imagine it is a one-way ticket. The money has to flow. And that's really what it is. It's money literally flowing somewhere. Maybe you need, that's the reason I bring it up, because if you've ever seen those horrible videos, and they're on YouTube, it will blow your mind. There's a few where people are like standing by the river and they're like, oh look, here comes the water, and the alarms are going off. They're like, oh, here comes the water. Oh yeah, it's nice. Yeah, here it comes. Oh, look, there's things floating in the water. Oh, here comes a boat. We're fine. They're just standing there next to because it's like a floodgate that's designed for tsunamis. And they're like, woo, it's getting deep. Hey, it's getting deeper. Oh my gosh, it's pretty high up on the wall. Hey, it's like right on the wall. I probably should step back. And then it just keeps coming and coming and coming and comes right over the wall. And you're like, oh, snap. And then they're running for their lives. And in many cases, it's too late. So anyways, if you could have a visualization of a fundamental change, it's that relentless money flowing somewhere new. It was over here, now it's going over there, and you'd be a fool to stand in the way. Okay? That's how I want you to think of a fundamental change. It's not coming back, and you're not going to trade against it. So like I said yesterday, be aggressive to get in, manage your stop. Get in, jam your stop, and let it go. So like this, just imagine when you get them changed like that, very large, very conservative institutional investors that have an outlook for their currency from 1 to even 5 or 6 years, it forces them to change their portfolio. And they don't want to change their portfolio because that's risk. They're not traders, right? There could be insurance companies, or it could be other central banks. It's bond funds. I mean, it's just big, large institutional investors with large time frames, and they're not the ones that are betting that the Fed's going to raise interest rates next meeting, and then you find out they're not going to. So then they start betting that's going to be the next meeting. That doesn't happen. So they start betting on the next meeting. Well, that's not the big investors. Okay, those are like hedge funds and stuff, right? When Janet Yellen, under testimony to Congress, says flat out, yep, we're going to do it, it forces the big boys now, they have to adjust for that change in central banking policy, because it will impact them one way or another in various ways depending on who they are. Igor, genius. No, Igor, I'm not a genius. I'm just like you and every other trader in this room. I'm a hard worker that spends a lot of time trying to improve, and I just have been doing this for over 10 years. The only difference between you and I is I've been doing it longer. Genius? No. What you should take away is that if it's predictable like that, then you can learn it and understand it and possibly profit from it in the future. That's what I want your takeaway to be. Okay, so anyways, it went up. It doesn't look like much. Let me go back to what I was saying about this one. Okay, you didn't get the 3A2, but this is a cycle level right here, big one, right? 129.00. And, it was tradable on a 5-minute chart if you were watching that. I was using 1-minute charts, but anyways, and so it did move up. And, you know, the top here, so if you bought near the psych level, come on, there we go. The top was, you know, 60 pips, 57. I mean, it's not huge, but you could have made something. Now, to get in low here before, you would have had to have bet. I sent Daniel a message, and I said, hey, Daniel, right? 19 minutes, I think I said, this Bank of Canada is going to make a decision. And then 90 seconds before it came out, I said, hey, Daniel, 55% of analysts think they're going to cut interest rates. And then, boom, they cut interest rates. But, you know, 55%, that's barely, you know, it's basically 50-50, right? So to be in before, you would have to have been a gambler. And the only way to have done it is, you know, a day or two before, you say to yourself, I know, you don't know the price, but you know the time. You know that this is going to be when the Bank of Canada makes the announcement. It's on the calendar. We covered it on Monday. It's not shocking. And you say to yourself, because of the fundamentals, let's say because of oil prices being down and likely to be down for a very long time, that I think they're going to cut interest rates. Now, what I said, I think I said it on Monday. I don't know if cutting interest rates is going to help them, but I guess if you're a central banker, you have to do something, right? Right? I mean, I guess. I don't think it's going to solve the oil prices being low. You know, their interest rates are not high now, anyways. So, you know, I don't know. I'm not sure what it's going to achieve, but I suppose it doesn't hurt, right? So, anyways, the only way to have done it conservatively is you made the decision because you said, I want to be a short CAD when that news comes out, but I also want my stop to be at break even. That's the only way to have done it. And to put it in the context of other things, you know, we've been talking about being, you know, we've been mostly long for a long time. Then remember, this was the target, right? This green, I'll make a light green zone. That was the target, right? And now we're way up here. Cool. Right on. Well, we broke through, right? Now, the interesting thing is the first 700 pips were easy. And then this was uncertain. What do you think would have happened if they didn't cut interest rates? And that was my thought process too. If 55% of analysts think they will cut, well, 45% think they won't cut. I mean, there's a 45% chance they wouldn't have cut. What do you think would have happened? Well, maybe not this, but we were at resistance. But remember, Yellen was doing her thing. But maybe not up, certainly short-term dollar strength, right? And if you played it right, you would have got knocked out of break even or something, right? So if you're going to front run it longer term, like a central bank change in policy, then you should be in it a few days early. Let's say, you know, here, stops jumped and break even, you know, 8 hours, 12 hours, 24 hours before the news comes out. You jam your stop and take a walk. But again, I want to point out that, you know, it was understandable why they cut, but not guaranteed by any means. Okay, right? I mean, that's fair, right? Now, what else happens when one large commodity economy makes the call that they're in a world of hurt. Well, they all get hurt. So they all came down. Did anyone, yesterday we talked about the dairy auction, the Fontana dairy auction, in regards to the Kiwi dollar. How many people remember that? The auction came out negative 11. Negative 11%. Down 11%. Is that good for the Kiwi dollar or bad for the Kiwi dollar? But we talked about that, right? And that we've been in a downtrend for 6 months, right? How many people learned that for the very first time, that they just had no idea of the Kiwi dollar trading in a correlated fashion with global dairy prices, and that there's actually an event, a regular event on the calendar that's tradable in regards to the Kiwi dollar? How many people just never knew that, but now they know it, learned it for the first time? And you could say, this is one thing that I've picked up for sure by attending these webinars with Wayne. Yeah, I gave the website. Of course I'd give the website. Didn't even know it. Cool. Cool. Ezra already got it. Cool. So that's a takeaway, right? Right on. Cool. I like that. Now we know that's a fact. You're smarter than you were before. As a trader, you're one step closer to smart money. Cool beans. Let's take a look at our friend Euro. Finally got a direction, right? Which is nice. So one thing I talked about a couple of weeks ago was that, in particular, after the no vote, how calm the Euro USD was and how technically it traded. Remember that it filled the gap, just textbook, and it flipped at like pivot points and not random areas. And I was very thankful for that. I said it out loud many times. I'm like, this is good. It means the market has actually done what they were supposed to do and adjust and prepare for the inevitable. And every other move too has been that way, where oh, there's a vote for this, and oh, there's a vote for that, and the market's just very calm. Cool. Just I'm looking at this and it's very nice. Just very, very nice. If you were a bear, I think there are some trades in here, right? So what would the trade be today? Right? Or you can take the next one if you want. I would have done this one. Excuse me. So where's the sweet spot? So like I said before, identify the role reversal. I always look at the role reversal. Then I look for the 382 to 618 Fibonacci retracement. I like to look for things like pivot points, key psych levels. They're all going to be important, right? So here's a central pivot, right? To me, that seems tradable. Did I say daily? Yeah, sorry, meant weekly. Does that? I mean, I don't know. Is that tradable? I think from what I've taught you, that should look tradable. Is there anything bullish going on? Anything? Not in my opinion. So very good, right? Is that an amazing trade? Like when we started today, and I said, we should be very thankful for our good trading conditions. Someone said, "Well, can you go through a good trade?" Well, that's not a great trade. Nothing wrong with it. It's not amazing. It's not unamazing, but it behaved the way it's supposed to. And if you were a bear, that was catchable. Let's see, gold still doing what we said it would do. I guess we could look at it. I don't like to spend too much time on gold. So there's the price action that I've been drawing in advance. Can anyone confirm that I drew this series of orange lines, this 1, 2, 3, that I drew it for price actually did it? There was a guess, the whole thing's a giant guess. This creates the plausible low, and it retraces back to the role reversal in which it would reverse down here, and then we'd work our way down, right? Okay. So what did it do? Did it do what I said it? No. But it's the idea, right? That it would come down, try to make a low. I guessed it would make a low off here, but it did it off these areas. Okay, so 1150. The world was more worried about the psychological midpoint psych level. So 1150 versus the other one. Okay, but it shows you how simple it is, right? Down to 1150. Make a Fibonacci retracement. And then extend lower, right? Nothing crazy or unique, right? Right? I mean, boring, right? Zoom in a little bit. Come on, man. Yeah, there's a lot going on in here. Let me get rid of this. Let's mess my stuff up. All right, so anyways. So gold and oil, we got those coming down properly. You should be tracking the commodities so that you could trade the commodity currencies, right? Okay. Oh, you want to do Aussie? Okay. Let me do that for you. Did you short at the 382? It happened, what, 12 hours ago? Good job. Okay. So here's our Aussie. Okay. What you want to do? What you want to do? Let's take yesterday's low, yesterday's high. Oh, snap. That's it. I mean, did you short it? Oh, okay. This is the Pacific yeah, Pacific Open, the Auckland Open. Okay, Asia Open, it's Tokyo, London Open, and New York. I have opening. I think I have it set for 9. Okay, so and then the number next to it, how many pips it moved. Okay, so it moved 22 pips on the Pacific Open, 28 pips on the Asia Open, and I can't quite see that. Okay, I can't quite see the London number, but 40 just gives you an idea of the range. So like yesterday, the Aussie dollar moved 45.4 pips in the London morning. Okay. And then it moved 86.4 pips in the London afternoon, otherwise known as the New York session. Okay. All right. So, anyways, does it seem to you that yesterday the Aussie dollar was bearish? Is that what your analysis was when you went through the daily chart today? So you analyzed your currency charts and you said, this looks bearish to me. All I need, now that I have a lower low, all I need is a Fibonacci retracement somewhere between the 382 and 618, right? Ideally, it'll near the roll reversal, which I've identified as this. Okay. Another way of doing it is like Nuno. I don't know if Nuno's here, but Nuno does is takes the two closest levels of support and resistance and marks it on the charts. Do you guys read his stuff on Forex.today? You should. So he likes to look at the closest 2 levels. So he'll have 2 levels of resistance, 2 levels of support. And then he believes that it always moves through to the second one. So he goes like, the closest one is secondary and the farther one is primary. So anyways, your trade plan could be like, I like to look to short either here or up here. Oh, but there's also, so here's the 3A2. And then you might look at midpoint psych levels and all these different things. But, there's a lot going on here for the bear. Okay? If you shorted this, I mean, this is an hourly chart, right? So if you were in this red cluster on a 5-minute chart, it was a good trade. Now you were going against the hourly Stokes, but whatever, dude. Right? I mean, the Aussie's falling fast and furiously. You were at resistance. You're at the roll reversal. On a 5-minute chart, if you got a 1 to 3, take it. It lost money. So what? Stop you crying. That would have been a good trade. It didn't work out. So you back yourself out. How about near the psychological level of 74? Is that tradable, guys? I think you should be short at 74. Because you have the 3A2, you got the psych level, you got the roll reversal, right? I mean, it's there if you have a trade plan. But we know that the majority of newer traders, they don't open up their daily chart and say, okay, after this giant fundamental change, I'm going to look at the price action. I see that it's made a lower low. I'm going to look for areas of support, which will now act as resistance. I'm going to take out my Fibonacci study, and I'm going to look at it I'm going to pay attention to the 3A2 to the 618. So on and so forth. We just know they're not doing almost any of that, right? What they do is this. I know it's not you, that's why I'm saying they. They just zoom into their 15-minute chart and they're like, oh, I'm buying it. Right? I'm going to buy it. It made a higher high, higher low, higher high, higher low. So now I'm going to buy it. I'm going to wait till we get to 74. I'm going to wait till we get to the 3A2, and I'm going to buy it. And it starts to come down like a ton of bricks, right? So that's why you need to start on the higher time frame first and say, what do you want to do with this? Do you want to be long here or short here? Okay. Now you could be long. I think it's super aggressive, but let's look at that one. There was one in there. Okay. This is support. Okay. This is resistance. And you would have done a fib study. Okay. About 50% off of the daily support pivot, and you're long. So if you're long and your stop is somewhere in this red zone, like your stop's here, you're fine, dude. Good trade. Okay. But what I've taught you is whether you're a bull or a bear, you still need to do analysis to discern what the other trader is going to do. It's your counterparty risk, so to speak. So if you're here as a bull, cool. Where are the bears going to sell? Well, how about at 74 near the 3A2? Yeah, I think they might sell there. So somewhere up in here, if you were a bull, you probably should have taken profit, put those pips in your pocket, and walked away. Okay? You would have made about 25 pips, 25 or 30 pips. Okay? No, you have to ask that all the time, Abdul. All the time. What are the other guys going to do? It will help you identify levels of risk to your trade, even though it's counter to your belief. If it's obvious, somebody is going to trade there, even if it's wrong, even if it's dumb. Yes, thank you. So even if it's dumb, somebody's going to do it because this is a very deep market, right? Very, very liquid. Lots and lots and lots of market participants. And they're participating in the market for many, many, many different reasons. So you could be short-term long and they're going to be long-term short. And, unless you understand each other, you're not going to play well together. So you could be a short-term trader and say, I'm going to trade the double bottom. It's made a higher high. So what did we talk about yesterday? What was a big chunk of our session yesterday? Double bottom, higher high, right? Higher low, long it. Okay? Right? Right? Didn't we spend like, I don't know, 20 minutes to a half an hour just on that one thing? And then I said that if you can do that one thing, that you could start your trading career. And then we started talking about if you could just consistently produce mediocre results, it's the consistency part that's important, then there's tons of money in the world for you. You can go get it yourself. I can help you. I can give you some money if you want. Just show me that you can produce at least mediocre results and do it consistently. I'm not even asking you for more. I'm not asking you to be a great trader. Just very consistently produce something. Well, how do you do that? Well, you have to be able to control your behavior, which means your trading is very consistent, right? The commodity prices might be going up, commodity prices might be going down, central banks are raising interest rates, central banks are lowering interest rates, the market's aggressive, the market's quiet. Meanwhile, you keep doing the same thing. Double bottoms that make a higher high, you wait for a retracement and you long it. Double top that produces a lower low, you wait for a retracement and you sell it. That's all you do. Very, very consistent behavior in a very inconsistent market, and it doesn't produce a huge amount of money, right? But 60% of the time it works every time. Huh. Now, if you happen to have 5 or 6 or 7 different patterns like this, then you're going to have better results, right? So anyways, this was a lame trade in the wrong direction, in my humble opinion. Now, of course, I could be wrong. This thing go up to the 618. Well, how would I know? But I can anticipate somebody selling the 74 line off the 382. That it's predictable, right? But anyways, you could have taken this one, just like we spoke about for a half hour yesterday, and you would have made money. That's it. Is it a lot of money? No. Didn't ask you to make a lot of money. I'm asking you to take control of your behavior, because you cannot control the market, but you're supposed to be able to control your behavior. Wyatt has a lot of pop culture. He catches my strange references. Wyatt, in my book, there's a subchapter, and it's called "There Is No Spoon." but I never reference matrix. It's just, that's it. That's the subtitle. It's funny, huh? All right. Bomb, 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 bomb. Somebody's buying it. Do it, do it, do it, do it. What do you stink? It's you I'm fighting for. Wow, huh? Draghi? What's Draghi saying? Draghi. Come on, Mario. Yeah. So he's gonna QE is proceeding smoothly. He reiterates we see a sustained adjusted inflation. Fine. So just be careful as he flaps his lips. Anything could happen. What's the title of my book? Strategic and Tactical Forex Trading. All right. Beep, 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 beep. Some questions about the yen yen. We can do some yen. Where to buy it? The Goodwill store? Maybe Amazon.com has it. Oh, yeah. Yep. Amazon got everything. Alrighty then. Kiwi yen. We were talking about I would like to corner the market on Kiwi someday. Someday. But when? Okay. Now, this was our plan on Monday. We were at the 382 Fibonacci, or no, sorry, the 382. It's funny how it just comes out, right? The M3 weekly pivot point, right? And I drew this, okay? And what we talked about was that if this heads down, based on pivot point theory, we did this up here, guys. Based on pivot point theory, M1 is the predicted bottom, which is also just happens to be the monthly support pivot. So we talked about this 2 days ago, coming down to here. How did we do? Right? Since we're talking about the book, which I wrote, what, 7 years ago, predicts M3 will produce a move to M1, which is what happened here. Here's M1, here's M3. What do you think? How would you grade that? We did. You and I spoke about this on Monday. Highlighted that it was pivots. Highlighted that it wasn't my opinion. It's just technical analysis. It's something that you can learn. You can see and learn. And then we have these arrows here saying, you know, if it headed down there, wouldn't it be interesting? Because I would someday, I would like to be long this pair. Maybe not today, maybe not tomorrow, maybe not next week, but someday, right? When you're all alone and the world is cold, at least you're long the kiwi yen. So I'm hoping you're taking notes, especially when we go back. I hope you have like aha moments where you're like, holy crap, we did talk about that. My God, right? That's what you should be saying. You should fall out of your chair, hit your head on the desk on the way down, wake up in a pool of your own spit because you've been drooling as you've been passed out, dreaming about how you're going to be a pivot point trade from now on. And you wake up a new person with a big lump on you that reminds you. That's what I want for you. Okay? So that's the Kiwi. How about our friend the Aussie? Funny, huh? You see the channel way at the top of the left? Now it's acting as support down here. Weird. Even Aussie is going up now. Shows you how weak that yen is, huh? Well, what did we learn over the last 48 hours? We learned that the Japanese are admitting that they are not going to hit their target, that they reduced their expected inflation from 2% to 1.7%, right? Right? That is a fact, right? Okay. So what is Abe and Kuroda going to do about it? Stop quantitative easing or add to quantitative easing? Because remember, it's not the news, it's the central bank's anticipated response to the news that's important. So how do you make money on that? We want to make sure we've got the basics taken care of. You got the looks, I got the brains. Let's make lots of money. What happens when a central bank produces quantitative easing? Cause, effect. What happens? The value of the currency goes down because the supply of the currency goes up. Money supply. Right? Let's see. Do 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 do. Let's add euro. Boop. Nice chart, right? Isn't that funny? Whoever created the default templates on MT4, I don't think ever traded anything. And then for MT4, after all these years, to still have these stupid default charts and layouts, it's just funny to me. But, it's always these, a non-trader hiring a non-trading programmer to build these things. I think it was the Dealbook 360 that GFT had. I actually know the guy that made the Dealbook 360. His name was Mohammed. And I used to have one of the only copies of the institutional version of the Dealbook 360. It's pretty cool. I don't know if you guys know this, but when I worked with GFT, I had my own dealing desk at GFT, which was probably the third largest Forex broker in the United States. I had my own dealing desk and my own employees at GFT that would clear my trades. Did you know that? There was actually a set of rules and regulations specifically for my trades. And the NFA even had to go over there and audit those rules and regulations and make sure that the systems were set up properly at GFT. So like, if this happened, what's the process in place? Like, who's going to contact Wayne if there's a problem clearing the trades? Isn't that funny? Like, literally, they set it up, NFA went over, sat down with GFT, and audited them and their specific processes for clearing my trades. Hoo-ha! How many people do you think they did that for? Yeah, that was a special one. All right, so what was I thinking here? I was thinking about the increase of money supply. So how am I going to do this? The supply of money. How should we do this? Supply of money maybe grows this way. Let's say 1 trillion, 2 trillion, 3 trillion, 4 trillion, right? So it would look kind of like this, the supply curve, right? And on this side, usually it has to do with the demand for money, right? So let's call it interest rates, because when the central bank wants to increase demand, they'll lower interest rates. If they want to decrease demand, they raise interest rates, right? So we'll talk about like 1, 2, 3, 4. I think this will work out. 5. So this is money supply. Always label your charts. Money supply. And then you're going to get like this. Is it going to work? Yeah, if you raise interest rates, you're going to lower the amount of money in the economy. And when you lower interest rates, which is here, you're going to raise the amount of supply. Yeah. Okay, that works. So, and then this, if we're going to continue with this thought process, I hope you don't mind. You take, well, let me change my drawing tool here. Tool line. You take this equilibrium point, oops, is going to equal where the interest rates are. So in that case, okay. And another way of looking at it is, if you want to increase the money supply to 5 trillion units from 3 trillion units, right? Did I draw that right? think so, because eventually when there's too much money, it's going to create inflation and you'll have to raise interest rates. Yeah, it's depending on the point of view that you're looking at that, right? And so what they're trying to do now is increase the money supply, or what they'll need to do is increase the money supply. And the interesting thing is interest rates are already at zero, right? So they're going to have to buy some bonds. And what does that do to interest rates? Right, they're going to have to print some money, buy some more JGBs. Print some money, buy more JGBs. Interest rates in Japan stay at zero. They're going to buy lots of JGBs. So the Bank of Japan's balance sheet will increase because they'll actually buy the money or buy the bonds from a bond dealer, from a JGB, Japanese government bond dealer. So they'll get the bonds and it'll go on to the balance sheet because they'll own it as an asset, which they can buy and sell that. They can sell that asset whenever they want, or keep it right till maturity. And then the money is transferred to the bond dealer, who then puts it in their bank account, which then increases the money supply. And through the fractional banking system, depending on what the reserve requirement ratio in Japan is, will increase the money supply exponentially. So if they're increasing the money supply, it does a lot of different things. Because the Bank of Japan is buying the JGBs, the price of the JGB goes up, but the yield goes down. So that's one thing that's depressing the yields in Japan, and will stay, in particular when they're staying. But then that money goes into the system and then is multiplied. So in the United States, the reserve requirement ratio, the RRR, is 10%. Okay, so 1 over R plus E, blah, 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 blah. The amount of money is huge. So if the Fed bought 10 billion in bonds, 100 billion is added to the economy. Okay, so then you got to multiply that by 100 if you're thinking yen. So the numbers are really big. But so interest rates fall because they're buying bonds. So the interest rates fall, bond prices rise, the balance sheet at the Bank of Japan rises. The money supply increases exponentially, and anything that, if there's more supply, and in fact, if the velocity of supply is quick and the expected trend in the growth is projected to continue, then the outlook for today and the near future would be weakness in value in each individual currency because of the purchasing power, right? The purchasing power parity is being diminished. Lots of different topics in there, but the value of the yen should weaken under these circumstances. I hope you understand why. Using all that hopefully helps. I hope you guys find it fascinating. Wyatt just had a heart attack. I think I have a headache. Wyatt's going to go watch some movies from the 90s. RRR, the reserve requirement ratio, has to do with how much money. Let me know if I'm going into too much detail. Okay, so you have a balance sheet. You're a bank manager now, okay? Oh, I got to get a pen out. Tool, pen. All right. You're the manager of the bank. Okay? Congratulations, you're a bank manager. Okay? So you have a balance sheet. Okay? You have assets, and liabilities. You following me? Okay. And you have 100 million in deposits. Why is it a liability and not an asset? It's 100 million in cash. Why is it a liability? Because it's other people's money. OPM. You owe it to them. If your depositor showed and said, you know, give me $100, you have to give them $100, and you'd have to subtract it from the 100 million and give it to them. Okay. Now, how do banks make money then? Are they doing that for free? They loan out the money. Okay, well, if you go back to the history of the Federal Reserve, and even before the history of the Federal Reserve, the history of the economy in the United States, as an example, there was a lot of times before a central bank existed to have rules and regulations like the reserve requirement ratio. A lot of banks would just go bust because they would loan out so much money that if someone actually showed up and said, you know, I'd like to withdraw $1,000, they're like, oh my God, we don't have $1,000. We're good for it. We've made a whole bunch of loans, and they're all good loans, and they're going to make their interest payments every single day. We're going to make a lot of money. They're good performing assets. So can you come back next year and ask for $1,000? They're like, the hell with you. Give me my money. So when a central bank was created in the United States, and the first one I believe was in Sweden, and the Bank of England was, you know, 100 years later. And that was hundreds of years before the Fed. But anyways, a central bank, one of the things that they do is control how much of the money, how much of the 100 million in client money you're allowed to loan out, and how much you should keep on reserve just in case. You know, you need that cash on hand in case your depositors show up and say, I'd like some of my money. You're like, okay, well, I have some of your money. So in the United States, the Fed says you are required out of your reserves, okay, to keep 10%. The reserve requirement ratio is 10% in the United States. It hasn't changed since 1992. All right. So if you have 100 million, 10 million is held at the Fed, okay? And that's the required reserves. And let's say you're a conservative bank manager. You like to keep a little extra above the minimum. So your excess reserves, anything you're holding at the Fed, excessive of what you're required is excess reserves. So let's say you keep 2 million. Okay? The rest you can loan out. So you could have, let's or let's say you have you're allowed to buy some government bonds with this money. You're not allowed to buy stock or corporate bonds, but you buy some like 10-year T-notes, and you got 8 million of that. And that's good because, that's guaranteed from the government. And also, if you have a liquidity crisis where you don't have enough to cover a withdrawal, let's say your largest depositor decides to leave or dies and the money is distributed to other banks, you could also liquidate some of your bond holdings and it wouldn't be a problem. Okay? And then you have your loans now, and these are not that easy to get out of, okay? But they pay a higher interest rate than the bonds, probably, right? If you were in a 10-year T-note, they're only paying, what, 2.22? But your loans, you might be charging 5%. So these are awesome, right? And what is this, 70? Okay. And this should all balance, right? So now the formula for the money supply, the change in money supply in the overall economy now is 1 over required reserves plus any excess reserves. And now you can figure out, okay, any, if the Fed added an X number of dollars through quantitative easing, for example, you could figure out the change in money supply, and it has to do with how much the required reserves are, how much any excess reserves the average banker is holding. Now, traditionally, the excess reserves were like 0. Currently, they're probably like that's 100. So let's make this 25. Like the amount of excess reserves right now is huge. So what the Fed has created, most of it isn't even in the economy yet. Okay. So the other thing to look at, okay, and there's some, by the way, if you go to youtube.com/c/TradersWay, I've talked about some of these topics before and just do a search. Okay. So you can look at the reserve requirement and ratio, and I think that's an interesting fundamental topic to understand. But the other thing I mentioned was purchasing power parity. And that's another interesting topic that you should look at. And in particular, one of the things I like to use when getting to understand purchasing power parity, again, a concept that's important to understand which economies are overvalued, which economies are undervalued. And as currency traders, that's important to us, right? But when you look at purchasing power parity, PPP, go to The Economist, the magazine, the English magazine. Did I mess up that answer? Sorry, Meter. But I had the 8 million in bonds. So yeah, I guess it was 80, right? Sorry. All right, so purchasing power parity, go to The Economist, the British magazine, and they produce something from time to time called the Big Mac Index. The theory is you have something ubiquitous, okay, something that you can get anywhere on the planet, and it's commoditized, meaning there's no scarcity. And the theory is if the whole planet used one currency like the US dollar, And in the United States, a Big Mac was like $1. Now, we know it's more than that now, but let's just take that in mind, right? Then it should, by theory, be $1 everywhere on the planet because everyone's using the same currency. And there shouldn't be a reason why it's more in Japan or less in China, and don't even think about Venezuela, right? But it should be the same, right? If purchasing power was at parity. Well, you can index the whole sucker and say, well, what is a Big Mac worth in China versus in the United Kingdom or France or Venezuela? And you'll find out, like, Big Macs in Tokyo historically have been a lot more than in Beijing. And what does that mean? And it's a very interesting thing if you look into it and start with the Big Mac index, and maybe you buy a book on Amazon.com about, there must be one, I'm sure, on purchasing power parity. And then in the theories related to currency trading and valuations of foreign exchange, it could lead somewhere interesting. Right? Abdul says a bank can borrow money at great leverage from from the Reserve Bank. Well, that's not necessarily said correctly. A member bank can borrow from the central bank to have enough liquid money on hand to cover their required reserve. All right? So if you're required to have 10%, but you only have 9.8%, because of some withdrawals that occurred over the last 48 hours, you're going to need to borrow from the central bank, and they're going to charge you interest for that, but they're not leveraging it. The fractional reserve banking system leverages it because, and then we got to end this because, I've been babbling on for hours now. Because, Bank One, right, takes their money and loans out, I don't know, we'll make a number, a million, right? And whoever that gets loaned out to, they spend it, right? They buy something with it because that's why they needed a loan. So then that million is transferred from one bank to bank two. So like if you bought a car, you borrowed money and then you gave whoever had the car the money, and then you have a car now, but then somebody doesn't have a car anymore, but now they have your money, and they put it in the bank. So it goes into bank two. And that 1 million gets there, right? But what happens? 10% of that goes to the central bank, and 90% of that is loaned out to bank two. Bank two then eventually has to transfer it for whatever has been purchased. Now it has to go to bank three because there was a transfer of that wealth that was loaned out, and the loans got spent. So now that goes to bank three, and now 90% of that gets loaned out. And if you could see, this $1 million is growing. And eventually, if you carry this out, from bank to bank to bank, 90% goes to a new bank, 10% goes to the Fed. Then 90% of that gets loaned out, 10% goes to the Fed. 90% of that gets loaned out, that goes to the Fed. 90% of that goes loaned out, that goes to the Fed. 90% of that goes loaned out, and then it just goes over and over and over, dozens and dozens of time. And guess what? At the end of it, $10 million was added to the economy, assuming that this 1 million came from somewhere else. And the fractional reserve system created the other 9 million. So the change in money supply through the fractional reserve system was 9 million, because you got to take, you got to subtract the original, right? And that money was invented. That 9 million never existed. did the Federal Reserve print that? No. Did the Fed allow the bank to leverage up to create that? Was it created through leverage? No. The fractional reserve banking system created that. Okay? So, again, I like to be very specific in our language when we communicate. Okay? And it's amazing how much incorrect information I hear and see. A lot of people just don't understand a lot of this stuff. And there's a lot of misinformation out there. My gosh, if you just do a search on YouTube for, like, you know, Federal Reserve, 90% of it comes up conspiracy theory. The Fed's evil and it's designed to enslave people, and and the Illuminati is using it to enslave the people. No, no. But we could debate that. So, like, it obviously it comes down to opinion, and a lot of people really do hate the Fed. And I remember when I first started trading currencies, I don't know, 12 or 13 years ago. My wife worked for a wealth management fund that had, $300 million, and I would meet with those guys, and they would laugh at me because I wanted to be a currency trader, and I was quitting my job. I was vice president of a venture capital firm in San Francisco. I was quitting that to become a currency trader. They thought that was laughable. How stupid. Two, I used technical analysis. Technical analysis was like, they laughed. It was laughable. And one of the other things that at least one of these guys on the team thought, he still hates the Fed. And I'm sure we can now sit down closer to equals now as time has gone by, and we can sit and probably debate whether the Fed's good or not. And I believe it's a good thing. And there, a lot of people don't think so, and that's fair. But I'll tell you what, this last financial crisis, you can thank Ben Bernanke. Nobody else saved you. And it certainly wasn't the government. It wasn't Congress. It wasn't the Senate. It wasn't the President of the United States. It wasn't, the finance minister. Wasn't the Secretary of the Treasury. Paulson was a little late. No, I don't think TARP did it either. And the only thing the government did that actually worked was the cash for clunkers. But anyways, once the crisis was obvious, we had every major central bank in the world get together and coordinate their zero interest rate policy. And then they each took turns doing quantitative easing so that it would actually do something. Because remember, if everyone did quantitative easing at the same time, it would have no effect. So it's just very interesting that what actually happened was amazing, and it was not the government that saved us. If you go back to the history of, let's say, the Great Depression, which was also the last global recession, was the Great Depression. And the Fed totally messed that up. But at the time, what they were trying to do is they thought staying on the gold standard was the most important thing. And if you look at how gold played a role at that time, it actually hindered central banking. You couldn't really do it because of being tied to gold, and that's another reason we had to get off the gold standard. But nonetheless, the Fed was not a solution. It was part of the problem, only because of little things like we were stuck on the gold standard. If you increase supply, you would actually increase the value of money, which would actually do the opposite, and all that kind of stuff. So, long story short, the government saved the people, and specifically war. But the government was doing everything they possibly could do, and I still go out, and I just recently went to visit Roosevelt, where he spent his summers pondering how he was going to save the free world from global depression and maybe even avoid a global war. I've actually sat on the stone. There's a lookout point not far from his summer house. They call it the Little White House. And there's up on this ridge, you can look down for probably 40 miles in this valley below. There's just this beautiful lookout spot. And the Secret Service would take him there, and he would sit and ponder the world's problems. And from time to time, I like to go to visit and put myself in that similar situation. In fact, I did that when we were in our current global recession, and it wasn't clear what was going to happen. I would sit in that same spot, the exact same spot where Roosevelt pondered the same questions. Well, back then, he was the one that saved the world. That and a global world war and stripping Europe of all of its gold, that helped, because remember we lent the UK everything that they had to fight the war, so we basically bankrupted England, and then we went into Germany and stole all their gold. So that really helped to make America a global superpower. Besides that, all of Europe was leveled. So for about 30 or 40 years, America was the only game in town. Okay, well that helps to become a superpower, doesn't it? But long story short, here we go into our recent situation, and it came down to one person again, in my opinion, that saved the world, because again, of course, the Fed didn't do it alone. And that is very unique for a central banker to get everybody together and do coordinated actions at the same time. Just wonderful, unique programs, and to embrace quantitative easing. That was something invented by the Japanese. That was common central banking theme like it is now. That was unbelievably unique and very debatable whether it would work. And it's still not even quite 100% proven, right? But it came down to one man, in my opinion. So central banking's very, very interesting right now, and it's changing dramatically. The powers that central banks have, and the rules, and even like things like transparency. Just fabulous that now that you and we can work together and say, oh, we're going to listen to the Janet Yellen testimony. Oh, Carney speaking, right, with the MPC, and Carney speaking, Draghi speaking. Let's listen. Let's read the meeting minutes out of the Bank of Japan. This is what we did this week. It's fabulous that we have those opportunities, and it's great how they just spell out how to make money if you understand what they're saying. Gives us reasons to wake up in the morning, I suppose. So like I said, hey, thanks for being on my team. You keep me sharp, you keep me focused. Lots to be thankful for as well. The market is good. This is a great summer. I'm super happy. So I'll see you tomorrow. I think it's a Thursday, is that right? So that means I will see you at fxstreet.com tomorrow, as we do every Friday. And if I don't see you over there, then let me just wish you a happy weekend now. So peace on earth. May the pips be with you. May your profits be above average. Remember, subscribe to our YouTube channel. Leave a comment. Leave feedback. Take care of yourself. You hear? Cheers.